The market narrative are moving very, very fast, and it was all about this relief on trade and tariff that really move up the market in the last couple of weeks. And we think the removal of this worst-case scenario is good news for the equity market. But yes, as you said, the focus has now shifted to the bond market and the impact of rising rates on equity. So I think in the last couple of weeks, we think that the bulk of the move up in rates was for good reason. The bond market was also reflecting the improving growth outlook and the removal of this meaningful uncertainty. But now I think in the last couple of days, we are seeing rates moving up for the wrong reason, which is mostly about fiscal imbalances and budget uncertainty. And in the last couple of days, we are seeing the correlation between equities and bonds turning again, and basically the latest move up in rates is starting to hurt the equity markets.
Let me ask you a very basic question, which I think a lot of us ask at various times. If people get less happy with holding their bond portfolios and lower their bond portfolios and the yields pick up, is there not a natural feeling to think, right, okay, I'm going to put that asset into equity because I actually think the equity balance of risk is better and safer? Or actually is it the question, because I'm worried about the bond market, ergo I take my money out of the equity market as well?
Look, I think the initial move up in rates, again, was for good reason. The market reassessing the growth outlook, and you had a bit of shift away from bonds into equity, so risk-on rotation. Again, in the last few days, I think the move up in rates is very much about a higher term premium, so the market reassessing the fiscal outlook and worrying about higher rates starting to hit the equity market. From a valuation standpoint, stocks are quite expensive, in the US in particular, and now at 4.5% 10-year yield, the bond market is competing with equity valuation, right? So if you see higher rates without a growth offset, that's going to start to hit the equity market, and this is what investors are worrying about now.
And there seemed to be a golden level in the US bond market curve. It's not 5.1% on the 30 or the 20. It's still the 10-year everyone looks at, getting to somewhere in the region of 5%. If we do get back up to 5% in the US 10-year, do you expect the US and European equity markets to fall as aggressively as they did last time?
Yeah, I would think so. And I think we are already in the danger zone for equities. So, this week the 10-year went above 4.5% for the first time in a while. And we are seeing the equity market not being able to cope with that, right? So again, if we are seeing over the next couple of weeks clarity on the fiscal outlook in the US, the resolution of the fiscal impasse, and further progress on the tariff front, that might help the equity market to cope with higher rates. But look, what we've seen so far is earnings being downgraded. So the bulk of this rebound in equities was coming from valuation expansion. And at some point, if rates keep going higher without a growth offset, valuation won't be able to take the market much higher.
And where does this leave us on this extraordinary trade where we had a redux in European equities at the start of the year, and then we've seen the US retracing some of that gap in recent weeks as well? In terms of the European-US equity valuation story, where are we?
Look, we're still at a point where Europe is looking quite cheap on any metrics compared to the US in an historical context, right? So US is the expensive market. Europe is not depressed anymore, but it's still very, very reasonably valued compared to the US. And look, from a bond market standpoint, we think Europe is in a better situation. Not everywhere, but Germany has fiscal capacity, has a pretty decent fiscal situation. US is where we have an issue, where the debt is growing by the day, and as we are seeing with very high equity valuation, the equity market cannot cope with much higher interest rates.